Stocks trade in a range ahead of the weekend and big earnings from Reliance Industries and ICICI Bank. IT stocks managed some gains, but realty and metals take a beating.
HCL Tech reports mostly in-line performance and a relief for investors after Infosys weak showing. The company tells CNBC-TV18 it saw some cancellations and there could be customer focus on pricing going ahead.
Aditya Birla Group Chairman Kumar Mangalam Birla rejoins the board of Vodafone Idea 2 years after he stepped down. The street draws confidence from the move, pushing stocks of Vodafone and Indices up.
Private life insurers see bumper March new premium collections riding on a tax break expiry, but the stocks slip on fears that the best is behind them. Even ICICI Pru Life and life insurance stocks skid despite a strong fourth quarter.
Bajaj Auto Chief Rajiv Bajaj says he doesn't see the logic of a 1.5 lakh two-wheeler subsidy, adding that India can't build a future on SOPs. He also doesn't see the phasing out of FAME having a long-term impact. On another note, he reveals the Triumph model will be unveiled on the 27th of June in London.
Hello and welcome to Halftime Report. I'm Sonia Shenoy and with me are Ekta Batra and Mangalam Malu. Well, things are very quiet for the market. There's a little bit of red on the screen, but to be honest, it's a very, very range-bound market that we have on our hand. There's no major trigger up until now. Of course, there's Reliance in the evening and ICICI Bank tomorrow. But up until then, the market is just, spending time within this range of 17,600 to 17,800. There are plenty of cues to talk about on individual stocks, and we'll get to that in a bit. But for now, looks like it's a quiet day, quiet end to the week, perhaps.
Yeah. Hi, Sonia. Hi, Mangalam. Yes, absolutely. But, my eyes are going to be squarely focused in terms of what ICICI Bank throws up because Abhishek's poll has indicated that the street is anticipating the best NII growth for the bank in 8 years, leading to the highest ever quarterly profit for the bank as well. So the profit is expected to come in at around 8,972 odd crores. Gross slippages and asset quality, if there is an improvement, if there is loan growth which is steady, is going to bode very well for the entire financial sector, which in any case has outperformed on a month-to-date basis.
Yes, it has. And, I've been tracking this religiously at 12 p.m. every day for the last 4 or 5 days. The Nifty is at 17,600. So we start the show and we say that, there's not much which is happening. And eventually, by the end of it all, also not much happens. 17,650 to 17,600, that's where we are. The only couple of things that, are a little jittery today is the fact that the mid-cap index is underperforming. It's down by about 0.6%. The Nifty Bank is underperforming. So it's finding some resistance at that 42,500 mark. And we have more stocks declining than the number of stocks which are advancing. And the ones which are gaining as well, no great shakes out there. I mean, something like Dish TV is up 15%. We have a bunch of other stocks which are buzzing around as well. Not great fundamentals behind them, perhaps.
Okay, but Reliance, I think all eyes will be on that. Q4 numbers coming later today. So let's get Rima in first up to give us the key expectations from Reliance Jio this time around. Rima.
Well, it's expected to be a modest quarter for Reliance Jio this time. We're looking at a revenue growth of 1.8% on a quarter-on-quarter basis. And this, by the way, will be the slowest revenue growth that we've seen in the last 7 quarters. The key reason for that is the absence of a broad-based prepaid tariff hike. While the company has been getting a bit aggressive on the postpaid side, they've introduced a lot of family offerings, it doesn't move the needle on the top line. On margins, the company's margin trajectory has been upward. And this quarter, too, we are anticipating a 40 basis points improvement in margin sequentially, driving a 2.5% increase in the profitability. 2 key operating metrics. One of it is subscriber, which is basically your volume growth, and the other one is ARPU, which is your pricing growth. So in the month of January, according to the TRAI data, the company added 1.65 million subscribers. So analysts are anticipating that for the full quarter, the subscriber addition should be about 5 to 6 million. In terms of ARPUs, the average revenue per user, it's seen flat on a sequential basis. 178 rupees is the ARPU estimate according to consensus expectations. And I said the key reason for the ARPUs being flat is the absence of a large prepaid tariff hike.
Okay, all right, Rima, thanks very much for that. That's on the telecom business. But what is the expectation from Reliance's O2C business this quarter? Sonal is standing by to tell us what we can expect.
Well, it is expected to be a good quarter for the auto-chemicals business for Reliance Industries for a couple of reasons. Let me start with the first one. Crude oil prices, they are down both on a YOY basis and sequentially. 19% fall on a YOY basis is what we've seen, and 8% on a sequential basis. Additionally, Singapore GRMs, they have improved to levels of $8.2 per barrel in quarter 4 of FY23. Now, what will this do? We have seen demand improvement because of Chinese economy reopening. While Chinese economy has reopened, exports have gone higher as well, and that is something that will cap gains as far as product spreads in the petchem segment is concerned. So yes, petchem and refining will see a sequential improvement, but petchem will still be subdued versus historical averages. Now, let's take a look at some of the estimates. Jefferies thinks that the company will see a 10% sequential increase in the O2C business and 7% on a YOY basis to come in at 15,249 crore rupees. And if we just take a look at how O2C has been contributing to overall EBIT, it was at one of the highest levels back in quarter 4 FY22 at 91.8%. It did see a fall from there, but it has been increasing since then, and this time around it will be seeing higher levels of around 80%. This is as per ICICI Securities. So yes, it will contribute more to the business this time. Moving on to the GRM number, the company does not report it anymore, but there is an expectation that they will improve to $12.8 per barrel, which is an increase both on a YOY and on a quarter-on-quarter basis. Now about the upstream segment, it has been doing really well for the company, and it will not be an exception this time as well. 5% increase on a sequential basis, more than 100% on a YOY basis is what the upstream oil and gas business will do this time in terms of EBITDA. So both oil and gas and auto-chemicals will definitely be the stars this quarter.
All right, Sonal, thanks a lot for that. So that's, what one can expect from Reliance on the Geo front and the O2C front, which will be a driver of the profits this time around. But as we speak, the standard disclaimer up for you on the screen. Network 18 and TV 18, the companies that operate the channel you're watching, eventually owned by Reliance Industries itself. We take a short break. On the other side, we get chatting about the metal space. Amit Dixit of ICICI Securities joining. Welcome back. Let's talk about the steel sector. We've seen a couple of moves here on the metal space over the last couple of trading sessions. ICICI Securities has a report which indicates the spot raw material spreads are the highest level that we've seen all the way since August 2022 on the back of falling coking coal prices. ICICI Securities also believes that flat steel players such as Tata Steel are better placed versus longs players as well. So we thought of bringing the ICICI Securities analyst himself, Amit Dixit, joins in now to give us the rationale for his report and the way forward. Amit, first up, from what we've read about your report and what the views are going forward, we believe that stocks should do well. Why are they under pressure today? I mean, is it because of routine profit taking, or is there something structural?
No, so, what has happened that Chinese authorities have cautioned against the high prices of raw materials, and they have mentioned that there is some element of a speculation in the market, and they have actually embarked on certain checks to ensure that, hoarding doesn't happen and raw material prices don't rise under speculation. Now, this is not something very new. We have been seeing it for quite some time. Whenever prices really go high, you have these kind of checks, and then again things come back. Now, just to put it in perspective, currently Chinese steel price, if you look at it, it is like, if you look at past 15 years range, it is almost at 70th percentile. However, if you look at the profitability, that is at 12th percentile or 13th percentile. In rebars, in fact, people are still making losses. So clearly it has got to do with the high raw material cost that Chinese authorities are worried about. And therefore, if you iron ore has cracked around 4%, and that has pulled down the stocks. But I think it's a very transient phenomenon. Nothing I would read very structural into it.
Okay. Amit, hi. Welcome to the show. Just wanted to touch upon this factor with regards to China. Obviously, demand from China plays a critical role in terms of how metal prices move. What is your estimate in terms of where metal prices could go, considering that China is expected to pick up further pace? We had the GDP numbers go by. People are bullish on the fact that China's internal demand is probably going to see an uptick going forward. in that context, what are you advising your clients?
Yeah, thanks. So, what is happening in China, if you follow the indicators, look at M2, look at the credit indicators, look at credit impulse, and finally the real estate micro indicators, what we are seeing is that there is an uptick in that, progressive uptick, as it should happen. That first M2 grows, then your credit, followed by credit impulse, and then followed by your things on ground. So, if you look at the prices in 70 major cities, last month in March, actually, prices in 64 cities have risen, which is one of the highest levels we have seen in the recent times, in almost 1.5 years. So clearly that is good. What we see that, and PBOC has been injecting liquidity almost every day. So clearly the indication is clear. They want to stimulate growth. Now, this April to June quarter is actually peak for construction. So far, we have not really seen the growth coming as per the expectations. But what I believe that going forward in H2, we would see prices going higher and the demand basically getting back to the normalized levels in China. At no point in time I am mentioning that demand will grow at a supernormal growth that we have been accustomed to seeing in China. But even a single percentage shift in demand in China is always very good for the sector as a whole. And I think that would dispel some of the doubts that people have about the demand recovery. So all indicators are pointing towards things. It's just about it finally coming together.
A lot of these stocks, though, have lost quite a bit of value this year. Tata Steel, for example, is down about 10% this year. JSW Steel is down 10% this year. Of course, the market has corrected as well. But do you see any major recovery in these stocks? And if yes, what would your pecking order look like now?
Yeah, so Sonia, we would see, what people's expectations were initially in December when China opened up after COVID. People were expecting things to, suddenly improve overnight, and therefore stocks really went up. We were not optimistic at that point in time. The proof of pudding is in eating. So when we saw these indicators actually going up, so we grew optimistic. In fact, our change in stance happened in the month of March. Now, having said that, what I see that going ahead, the coking coal, for example, which is the most important indicator for India. Now, there is a difference between iron ore and coking coal. The thing is that China is quite dependent on its internal coking coal. So globally, coking coal prices going down don't have that much effect on prices in China. Steel prices in China, that is. While for Indian players, the spreads improve. And therefore, the spot spreads, when they will be built up in Q1 or Q2, you will find a material improvement. Now, just to give you the fact that coking coal price from an average, quarter Q4 FY23 has corrected almost $60 a ton when I look at Q1 FY24. So clearly that would be reflected in Q1, Q2. And the important point is that if China demand also there is some uptick, you will find that, the spreads would be better, the estimates would, people would reject their estimates upwards. And definitely, the stocks also should do better from here. So I think at this point in time, we would be relatively more positive on ferrous as compared to non-ferrous.
All right, more positive on ferrous. Amit, just a couple of points. I just wanted to know, since you said spreads are at an 8-month high, would you now look to adding some positions in the ferrous space? And secondly, you prefer flats versus longs. Can you give us a sense why?
Yeah, so if you look at longs, the channel checks that we have done, longs inventory is still pretty high. If you look at flat prices, people have increased their prices 4 times in a row. In fact, when I discussed last in your channel, I think it was 4 months back, then longs were trading at a premium of around 2,500 rupees to flat. Now that doesn't happen very often. Now, in fact, what we are seeing that flats are trading at a premium of roughly 500, 600 rupees a ton. So therefore, prices in flats have not corrected to that extent, but prices in longs have corrected. So therefore, we are relatively more, positive on flats versus longs.
Okay, just a quick word with regards to what your expectations are from Tata Steel this quarter. The reason I ask is that, last quarter, the European operations was quite a disappointment. Realizations were lower. There was a net EBITDA loss which they incurred, and costs were higher as well. They come out with numbers on the 2nd of May. What can we expect?
No, so if you look at the consensus estimate, it is somewhere around 5,000 to 5,500 crores. For chorus, I think everybody is penciling in around $100 per ton of loss. While standalone operations, there would be an EBITDA uptick of roughly 2,000 rupees a ton. So clearly, I think that, quarter on quarter, if you look at the numbers, from 4,000 odd crores, we would be, my own estimate is 5,250. So that uptick would be seen. Now going ahead, and that is more interesting, that we should look at Q1 FY24 when the spreads in domestic operations would improve. In Tata Steel Europe, falling coking coal prices will help them. Stable iron ore prices will help them. And the fact that European prices have actually stabilized. European prices are at 830 euros per ton, courtesy ArcelorMittal's curtailing operations in 2 furnaces in France and Italy. So therefore, that would support the price. And considering that they have come up with this carbon border tax adjustment, I think that should also help Europe. So Europe would be better, and therefore, if losses in Europe are curtailed and it springs towards its normalized profitability level of $40-45 a ton, we believe that for Tata Steel, the performance should improve here on, and therefore we have an ad rating on Tata Steel.
All right, Amit, always a pleasure speaking with you. Thank you so much for joining in and giving us your views. Positive on the ferrous space, positive on Tata Steel, and believes that the dips currently should be used to buy. Take a short break, come back on the other side. We speak about the pharmaceutical space in our special offering, Clutter Breaker.
All right, time now for a special offering, Clutter Breakers. Today, Ekta is standing by the big wall to give us a deep dive on how US dependence on API imports is taking place, the raw materials which are needed to make final drugs, and whether anything has changed since COVID-19. Ekta, over to you.
Thanks for that. Well, pre-pandemic, 80% of key starting materials and APIs manufacturers, the raw materials which are basically used to make final drugs, were located outside of the US. This dependence was one of the key issues that came to light during the pandemic, which has been described as a national security risk by the US. The key question now is, has the US's dependence reduced? The US government, approximately 3 years since the pandemic began, doesn't think so. A report by the United States Senate Committee on Homeland Security and Governmental Affairs earlier this year has indicated that as of 2021, majority of the FDA-approved API facilities were located outside of the US in India. And currently, 9 out of 10 injections which are used for critical acute care in the US rely on raw material from China and India. One of the key recommendations of the US government continues to be to invest in domestic manufacturing for critical generic drugs. And I quote, the federal government should build upon its efforts to engage industry and academic partners through private-public partnerships that incentivize strategic onshoring and advanced domestic manufacturing technologies for critical generic drugs. But the steps to shore up domestic manufacturing until now have been piecemeal and inadequate, point out experts. For example, Flow, the Virginia-based CDMO, was set up in 2020 and awarded a 4-year, $354 million contract. But as of last year, the company was still to meet major deadlines. Indian companies supplying to the US say they haven't seen any disruption to their order books either. Reasons include complacency post-COVID-19 to disrupt deeply entrenched supply chains, to the cost advantage, which sometimes can have an over 50% difference in rates, especially in advanced APIs. In fact, some API and intermediate manufacturers have seen a benefit of around 20% due to the China +1 factor. However, while the progress from the US could be slow, this is a space to watch. The US believes one of the reasons for the drug shortage, which has risen 30% year-on-year in 2022, and is at a 5-year high, with basic pediatric flu and fever medications seeing supply shortages, is in part linked to the over-reliance on APIs. And the US is adamant to ease it. Indian companies expect on-ground disruption, if any, to be possibly visible in a year or two. Lastly, experts say the US government is likely to look at a multi-pronged approach to improve the supply chains. These steps could include government fixed contracts, increased disclosures, and provide the FDA more teeth, such as mandatory recall authorities for all drugs.
All right, Ekta, thanks a lot for that. Insightful. We take this discussion forward with Aditya Khemka, who's the fund manager at InCred Healthcare PMS, and Vijay Garg, MD, Viva API Labs. But Vijay, of course, we know him as the previous head of IOL Chemicals as well. We have a lot of conversation with you during the time the API prices were surging, and we saw IOL Chemicals do well as well. This is during the pandemic. So good to connect with you again, Mr. Garg. Just wanted your thoughts on what Ekta's put out with regards to a trend, and how should Indian players foresee this?
Thank you very much. See, post-pandemic, what happened? Every country has this risk, which every country, even India, has it's a security risk. So China plus one model, which was announced by all the big, you can say all the regulated countries like US, UK, and Europe. See, what has happened, the approach was like earlier everything was going out of US or Europe or UK. But now what is happening post-COVID, every country has now come to know that self-reliance or self-dependence will be the only key. So as Ekta has rightly mentioned, that US government is trying hard to bring back all those drugs to US, but since it's very slow, so we can see in times to come, definitely the self-reliance will increase. Like India, if you see Indian government has come up with incentive linked schemes and pharma parks. It is what self-dependence will increase with all these efforts in India. Same is with the US. So now US is looking China plus one model. So where India will be really helpful in providing the complex chemistry intermediates to US, and US will definitely, it will take 2 to 3 years because in pharma generally it's a slow start.
Okay, Aditya Khemka, fund manager of InCred Healthcare PMS, also joins into this conversation. Aditya, you've been looking at the entire API space and API stocks very closely. Just wanted to ask you, with your conversations with a lot of these API companies, have they actually benefited from the China plus one factor? Because as of 2021, India had the maximum number of US FDA approved facilities for APIs outside of the US. So is that a real factor which has come through for India? And to the US-China relations, is that actually turning out to be another windfall gain for India?
Yes, so in fact it is. So if you look at majority of the API companies in India, regardless of whether the size of the company, all of them have done significant capex, and they have announced significant capex for the next 2-3 years, and they have done significant capex in the last 1 or 2 years. Now that is obviously driven by their order books. So their order books have gone up significantly higher than what it used to be historically. And to sort of service that order book, they need more capacity. So it is beyond doubt that the China plus one or the order inflow for these API companies has significantly gone. That I don't think is debatable. What is debatable probably is this entire US shifting of the production to US for critical drugs or for some drugs. I think there, in the US, there are two narratives. One is obviously they want to be self-reliant for at least certain critical drugs. The second is that they keep saying that drug prices are too high. Now, if drug prices are high, despite them being manufactured at low-cost destinations like China or India, then bringing the production home to US or any part of the US is going to make them even more costlier, right? So they are not going to have. So you have two parallel narratives, and the narratives don't match. There is no common ground for those two narratives. So I think at some point US will have to decide which of the two narratives do they want to sort of hold dearer to their heart.
Okay. Mr. Garg, now that China has come back into the fray in terms of manufacturing and all of the COVID-19 restrictions have been lifted, what is the change that you're seeing in API prices? Is there a further reduction, say, in the past 2 quarters in terms of API prices?
Yeah, definitely. After China has opened up, now the prices of API, prices of intermediates are going down. Already it has gone down to the tune of 20%, because what is happening now, China, after completely opening, they are trying to get their share back, because in last 2 years many Indian companies has taken position in US market, and to much extent in India as well. Like if I can give you example for paracetamol, earlier India was totally dependent on China, but now more than 50-60% of the production is happening in India only. So that way now China has the only one thing which they have is the price reduction, because they are sitting on huge capacities. So definitely prices are coming down. But looking at the position which companies are holding for China plus one model, so we expect that the Chinese reducing the prices will not impact so much.
Okay. All right. Aditya, just leave us with some stocks, because, the concern is with regards to the kind of correction that we've seen in a lot of these API stocks. Do you think that there's any kind of upside from current levels?
Yeah, I definitely think so. I think the API companies, majority of them currently face some operating deleverage, because they've created a lot of capacity, and in the capacity you have costs which have to be upfronted, and the revenue is back-ended. So there is some operating deleverage on their P&L and balance sheet today, which will get resolved over the next 2 to 3 years as the new capacities are monetized. In terms of the portfolio that I run, the Incred Healthcare PMS portfolio, the largest position in the API space that we have is Newland Laboratories, followed by Heikel, followed by Syngene, which has also entered into the API space now. So we are obviously more tilted towards innovator CDMO, so where the API companies are manufacturing the raw material and starting material for the innovator companies other than for the generic companies, because pricing tends to be less volatile there and the order book tends to be more stable there.
All right, gentlemen, thanks a lot for joining in. Appreciate your thoughts. Let's get back to the markets, though, by the way, which is under a bit of pressure. So just wanted to point that out. The Nifty is now down 40 points, and going into the numbers from both Reliance and ICICI Bank, market is not in the best mood. In fact, the mid-cap index is now down 200 points, led lower by a lot of IT stocks. Tech Mahindra is your top Nifty loser right now. And then you have steel names. So there's Tata Steel. Metal names in general, Hindalco, are under pressure. Tata Motors is under pressure. So there's a little bit of a profit taking that you're seeing in the market. Nothing alarming, but nevertheless, the market has moved to the low point of trade. In fact, good time to take a commercial break. When we come back, Cyient is one of the big movers in trade. It's buzzing after good Q4 earnings. Stay tuned for more on that. Welcome back to Halftime Report. Well, Cyient reported a very good quarter with a strong growth in revenues and margins. Earlier today, we spoke with Krishna Bodanapu, the MD and CEO at Cyient, to know more on their Q4 performance. He says that they are still confident about achieving FY24 revenue run rate of $1 billion. Listen in.
We've taken into account some degree of macro uncertainty, which we all can't escape. But taking into account some degree of macro uncertainty, we're still quite confident that we have a run rate towards that number essentially in Q4 of this financial year. There is still a lot of work to do, but we believe, will we be there? Surely thereabouts, but we're working hard towards getting there. So that's still a line of sight. There are some obvious risks in areas like semiconductors where there is a slowdown that is anticipated. But I would say, I think now we have a well-diversified portfolio. If you look at the 4 reporting sectors that we have, which is transportation, sustainability, connectivity, and new growth areas, they're all very balanced. I mean, they're all, a fourth each of the services business. Or if you add the manufacturing business, that's also about the same scale. So these 5 pillars that we have I think are working out very well. And let's face it, right? There were times when some of the sectors that we were in did not perform very well compared to the others in the market. And I'm referring to the aerospace sector here particularly. But now that sector has come back quite strongly. So I think we've positioned ourselves quite well.
All right, so that is Cyient, one of the top gainers in today's trading session. But we understand that Max has emerged as a front runner to buy care hospitals from TPG as per an Economic Times report. Ekta tells us more. Ekta, a lot happening in the hospital space.
Yes, never ending. As long as you're not going to a hospital, it's good.
Yeah.
But nonetheless, yes, there is an Economic Times report where Max has emerged as a front runner to buy care hospitals from TPG. Max and TPG have signed a deal exclusively for bilateral negotiations late last month. This took place last month. And Max, as per the report, has given a firm offer to TPG within the stipulated 6-week window. Now, it is a structured agreement with an option on the Bangladesh assets of care. Valuation is anywhere between 5,500 to 6,500 crores. The other contender, as per the report, continues to be Blackstone. Now, talks with multiple parties with regards to care hospitals has been hampered over disagreements with regards to valuations. At one time, valuations were over to the tune of 7,000 odd crores for this particular deal, as per some, conversations that I've had. And also the other point of contention was the international footprint. Now, CNBC-TV18 has not verified this report independently, but I just want to point out, on the point that Mangala made, is that there is a lot of deal activity in the entire hospital space. Just a couple of weeks ago, we were talking about Temasek buying 41% stake in Manipal hospitals for around 16,400 crores. And just yesterday, we had Fortis, which picked up a 355-bed hospital for around 225 crores, which will strengthen their position in Gurugram, where they have their key hospital, FMRI. So that's going to increase their bed capacity there. There are also a lot of deals in the pipeline within the entire hospital space. There's Manipal AMRI, which is basically the Imami-run hospital change. And the deal could be to the size of around 2,400 crores. Manipal and the Kerala-based private hospital chain, which could go to around 3,500 to 4,000 crores. So a lot to watch out for within this space.
A lot to watch out for indeed.
Absolutely. As she said, right, as long as you don't have to go to a hospital, everything else is okay. We're fine with it. But let's do one thing. Let's slip into a short break on that note. When we come back, more on the markets and more on stock-specific actions. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Perfect time to get in what's taking place in the F&O space. I mean, I was saying that, the last few days we've remained at the same level and we're virtually at the lower end of today's trading session. But the range itself has been very low. If you just take a look at the last 3 trading sessions, the high on the Nifty has been very, very similar. On April 19th, the high on the Nifty was 17,666. Yesterday was 17,684 and today 17,663. Within 10 to 15 points from each other. The day's low on the Nifty as well, extremely close to each other. Today's low on the Nifty was 17,589. We're towards the lower end of the session. Yesterday was 17,584 and day before yesterday was 17,580 itself. So the trading range on the Nifty has been just about 150, 160 odd points, and today's trading range has been just about 74 points. So this is perfect for option writers to go ahead and eat the premium at the ends of this range that we're looking at. So 17,700 call writers, extremely active. We're seeing almost 63 lakh shares written on it for a premium of 50 odd rupees, and 17,600 put writers. Both of them come up for you on the screen. That's about a crore shares in open interest outstanding with close to 80 rupees for premium. So that's selling you 17,520 at the lower level and 17,750 at the higher level is going to be the range that we're looking at. It's getting a lot more stock specific. So let's talk about one of those stocks itself. Delivery is the one that I'm watching out for, and not an F&O stock. It's a cash market stock, but an unusual mover today. Why is it moving unusually? Well, yesterday the news that came by was that Abhik Kumar Mitra has moved on from Delivery, was the chief customer service operator for the company. In fact, customer experience operator for the company. He's moved on post the successful integration of SpotOn. Before that, he was, of course, the CEO of SpotOn itself. Now, why is it that the stock is moving higher on this exit? Because one, the biggest overhang on the stock was the delay in integration with Spot On. So now that he's moved out, does it mean that the Spot On integration is successful? And if that one overhang goes away. Secondly, a couple of days ago, we got a note from Bernstein as well. They've initiated coverage on the stock with a market weight target price of 360. They believe that corrective actions taken by the company in recent months will drive recovery in earnings. However, on the way up, a long queue of PE exits will cap some returns as well. But by and large, over the last 3-4 trading sessions, we've seen some bit of an uptick come by on all these new age companies, be it Motilal Oswal initiating coverage on Paytm, Zomato, Bernstein initiating coverage on delivery. So successful integration, corrective actions, and a fresh look at the company's the new age companies, so to say, is driving the stock higher today.
Okay, also tracking some brokerage calls. Nuvama has written an interesting note on the footwear space. So what are they saying about that?
Well, about the footwear space, not something that you and I wouldn't know, Sonia, given our love for shoes already. The one thing that they've said is that the footwear industry in India, 30% organized, 70% unorganized. But in that is the organized pie, which is growing much faster. They've mapped, the details of the growth. Organized industry growing at 13% CAGR, unorganized growing at 9%. And inorganized itself, it's the sports and athleisure market which is growing much faster. So that's growing at a compounded growth of 17%. And in that, it's the premium athleisure market which is doing even better. A lot of people during the pandemic have begun to buy shoes online. So, by FY20, the online share was close to around 16%. They believe that by FY25, this will go all the way up to 22%. So this is another driver for them. They've initiated coverage on metro brands with a 20% plus sort of upside, 978 target price. But on Bata, they've initiated coverage with a hold rating. The reason why they say that is because Bata is in the midst of a repositioning drive from just being a value retailer. They want to be a fashion retailer, the sneaker studio, etc. that they've brought by. So, this is something that they will monitor to finally drive a sustainable same-store sales growth. So until that happens, you hold Bata, but buy Metro shoes.
Okay, all right. So that's on the entire footwear space. Well, it is turning out to be a very quiet session for the markets, but just watch out for a couple of stocks which are at fresh 52-week highs. ITC has been on a tear this entire year, so that stock is at a fresh 52-week high. Glenmark as well as Marksons, both these stocks have made fresh 52-week highs today, and Cyient post its numbers. Dalmia Bharat, a couple of stocks which are seeing some amount of upside in today's trading session. So there is a lot beneath the surface in today's trade. Time for a break now. On the other side, Manisha Gupta will join in. She has with her the editor-in-chief of Petroleum Economist. Stay tuned.
Well, we've incrementally slipped a little lower, and the Nifty is now below the 200-day moving average. 17,595 is the 200-day moving average. The Nifty at the low point of trade, 17,587. But nothing really to worry about. The first test of the 200-day moving average the last couple of days ago was supported, and we are pretty much in the support zone itself. It's the mid-cap index, which is facing a deeper cut, down almost 0.2%, and the Nifty banked down by about 0.5%. All eyes will be on Reliance, and then there will be ICICI reporting their numbers over the weekend. So Monday, we'll see an impact of these two heavyweights on the index. But that's about the equity markets. Let's talk all things commodities. Manisha.
Thank you so much for that. And I'm looking at the crude oil prices because, last 4 weeks have been constant gains, and we saw crude oil prices gain up by nearly 14% in last 4 weeks. But this week started on a weaker note, and then we've continued to decline. 3% down overnight. It's down 6% on week. On a month-on-month basis, still trading in the positive by 9%. Paul Hicken is editor-in-chief, Petroleum Economist, and he joins us now to talk further about that. Paul, hi, good to have you. What is your sense on what the crude prices have done this week? Because we've basically given up all the gains after OPEC and allies did that surprise cut. All right, we lost Paul, looks like that, but I'll tell you some more fundamentals here because we've seen prices go under profit-taking. Also because the markets are looking at very uneven demand recovery coming in from China. The kind of economic data that we've seen, the first quarter GDP numbers were on the stronger side, but all the other data slightly less than what the street was anticipating on an year-on-year basis there. The markets also have seen Russian exports continue to be stronger, even as they have done output cuts. We still have seen exports actually at pre-COVID levels. So 2019 2019 highs is what we are seeing in sense of Russian exports. And the markets are a bit concerned about the interest rate hikes as well. 25 basis point of a hike in the May is given and factored in. But the street is now worrying itself if whether or not there is going to be yet another rate hike, even if it is 25 basis point in the month of June as well. And not just US, there are similar statements coming in from ECB, Bank of England and Reserve Bank of Australia also says that the rate hike pause may be temporary and they will continue to look at the economic data before they make any more sense on where they are going on with the rate hikes there. If you look at the demand sense, we also have seen the crude oil inventories in US see a surge, and that pretty much has been the case with gasoline and distillates as well. So demand not so great, production has been on the higher side. So all attention now on the demand numbers rather than supply, because supply seems to be fine and on the higher side. But if the demand doesn't pick up, then the markets perhaps could continue to languish going forward.
All right, Manisha, thanks a lot for that. That's about the crude oil space. But there's also a lot going on in the electric vehicle space, and that's something that consumers can look at. The Indian government is not in favor of extending the EV subsidy scheme, but that was the word coming in from Rajiv Bajaj. We'll speak about that in just a bit, but in the meanwhile, we have Paul with us.
All right. Paul, we've been trying to get you and we've been getting in and off and on you, but tell us on what's your senses on prices.
Yeah, tell you about this. I'm on a train to see the IEA in Paris. But basically, it's a question of confidence in the market. We've seen China, the good data that came out of China for the first quarter, but still the market's not confident that China's going to continue this strong recovery. The same thing is being said from the US and the OECD, where there's still these concerns of banking crisis, there's still concerns that interest rates are going to keep going higher, and that is keeping a cap on confidence. So no one really wants to push the market too far higher right now. And you've got the OPEC plus voluntary cuts, which is trying to put a floor under the market at that $80 a barrel level. So really we're in this kind of volatile range where we're really waiting to see the China and the US to turn the corner in both in a positive way.
Paul, what's your own sense? I mean, we're just about holding 80 now for Brent. We've come down all the way from nearly 87, 88 on the higher side. Are we going further down as Brent also is at risk of breaking 80 on the lower side?
I think it's going to be very difficult for the market to really push the market below 80 given those OPEC plus production cuts. I think really we've reverted back to the range-bound trend before prices, and it's going to be another shock. Shock coming out.
Paul, also, how are you looking at the Indian and Asian demand going forward from here? Because all hopes were on China. Right. It's one of those days.
It's one of those days. So we're just like one of those hybrid cars, we're shuttling between both electric vehicles and crude oil vehicles. So in case your petrol car isn't starting, let's go across to the electric vehicle words.
Do that.
Coming in from Rajiv Bajaj, he spoke with us this morning and he spoke extensively about the government subsidy and the FAME policy, etc. So let's hear him out on EVs while Manisha and I deliberate on how expensive petrol has become these days and whether we will consider to buy an electric vehicle or not. But in the meanwhile, while they pull up those, words coming in from Rajiv Bajaj, okay, would you buy an electric vehicle in the near future?
I think we're all headed that way, aren't we? Because having said that, though, most energy experts do tell me that it is going to be at least 10 to 15 years before you see the crude oil demand peaking. So I think if you go by that, not everybody's going to have an EV, but it's going to be until 2035 or 40. I think that is the future clearly, isn't it?
All right. We will watch that. So you listen to what Rajiv Bajaj had to say, and thereafter we will wrap up on this edition of Halftime Report. Business Lunch comes up next.